Hello, beautiful people. Mr. Darston here. I'm very excited about today's lesson. I've been asked numerous times, Mr. Darston, are you going to put something out about trading? Can you help me learn to trade? The answer, of course, is yes. Let's get to it. All right, everyone. It's time to talk stock trading. I, of course, am your host, Mr. Darston, and welcome to Mr. Darston's 7 Rules for Trading Stocks. The first rule you must always remember is to only trade with a portion of your portfolio. Trading is very risky, very volatile. I do not advise anyone to trade their life savings or a huge chunk of your overall savings in a trading portfolio. We already talked about ways to develop a balanced portfolio tailor made for your needs. You still need to do that. But if you have a portion of money you want to allocate toward trying to get some big gains, trading may be the way to go. So, again, only trade with a portion of your portfolio. That is rule number one. Okay, I kind of covered it in rule number one, but this is so important. I wanted to make sure the message is clear. So, rule number two is do not risk more than you're willing to lose. Only allocate a portion of your assets that you can afford to not have should something go wrong to a trading account. Now we're getting to the good part. When trading stock, you want to look really sophisticated, really intelligent, right? Bump all that. The bottom line is you want to make money. And in order to make money, you need to learn to read a stock chart. To be a successful trader, you're going to need to develop your expertise at the basics and minimum, the basics of technical analysis. Now, one of the first things you're going to be confronted with when looking at a stock chart and being able to analyze it are stock candlesticks. So you need to understand the basics of what a candlestick is. Now, you have your, in this case, green candlestick, which indicates that the stock has moved up over a given period of time. So in a green candlestick, you're going to have certain portions that you're going to want to pay attention to. So those portions are going to be the starting point where it opens up, underlined here. And then you're going to look at this stem. It goes all the way through. Now the stem's peak is the high point the price got to within a given time frame. And of course, the low point of the stem is just the low point that a stock's price went to within a given time frame. Where there's a green candlestick, it indicates that the price closed at a higher position than it opened. And the closing will always be above the opening. Now, when you have a negative candlestick, it indicates that the opening price is higher than the closing price. That means, of course, the value went down over that time frame. You still have your stem that extends from the bottom to the top, indicating the high point during a given period and the low point as well. You're going to want to read these candlesticks. It's vitally important to helping you determine price action. And we'll get to that in a minute, but that's the basics of what a candlestick is for both a positive move and a negative move within a given time frame. Now, as we dig in to the nitty gritty of technical analysis, there are some terms that we absolutely must know. Now, I've listed 4 of the major ones here that I always use. There are some more that many traders use, but these 4 I find to be the primary ones that have helped me in my trading endeavors. And I'll start kind of in the middle. So, support. What is support? You may have heard of support and resistance. I'll start with support. Support is a level that refers to the price of a stock where it's probably not going to fall below for a period of time. It's created by buyers entering the market whenever an asset dips to a lower price. So typically, when an asset gets to a support level, the price will tend to go up from there. Now, it could break support, and then when it does that, that indicates that there's bearish momentum on the stock. Now, we also have resistance. Resistance is sort of the opposite of support. Resistance is a level that the stock price tends to not break. It approaches resistance and then it tends to come back down from that level. Now, if it breaks through resistance, that indicates a bullish move in the stock. Now, we want to talk about a moving average. So, a moving average indicates a period of time or a pre-selected period, 20 day, 20 minute, uh, things of that nature, moving average. And it tells you what the average stock price has been over those periods. Now, when we talk about the MACD or the moving average uh, convergence divergence, it takes two different moving averages and it lets you see when they intersect and when they start diverting. Those points where they come together lets you know the direction that the price action is moving on a stock. Finally, I want to talk about average true range. This indicator has been a big help for me in determining where to set my stop losses. It's a great tool to help protect me on the downside when my trades may be not going in the right direction. It helps me not to get kicked out too early and it helps me to not have large losses. So average true range is a volatility indicator that helps you put your markers in for your trades. If you don't have a plan, you have a plan to fail. Number four of my rules is develop an entry plan. Now you want to use the technical indicators we talked about earlier to figure out the price where you want to buy in on a stock trade. You also want to determine how much you want to risk on a trade. And you're going to, of course, set the number of shares you will buy based on that dollar value. You got in, so of course you got to get out. Rule number five is all about preparing an exit strategy. You want to start by setting your target return goal. You're making a trade to make money, so you're entering in with a certain level of return in mind. So if I get to this amount of money, this amount of return in my trade, I'm going to get out. Remember the old saying, pigs get fat, but hogs get slaughtered. Don't just let it ride. Have a goal that you're going to execute at when the price gets to your target level. Just as importantly, you want to protect yourself if things don't go as planned. You don't want to just sit there and lose everything. You want to come to a stopping point where you only lose so much. That's why placing a stop loss is so important. So, when placing a trade, number five in Darston's rules, prepare an exit strategy by setting a target return goal and placing a stop loss. So, you kind of have to track all of these things we talked about. And if you don't create a spreadsheet, I really don't know how you're going to be successful at doing that. So, rule number six is create a tracking sheet. Now, there's certain elements you're going to want to have on your tracking spreadsheet. I have 8 elements. I absolutely don't understand how you could have a sheet without these elements. So, number one, of course, is the ticker. What stock am I trading? The ticker lets you know that. Secondly, the time. What time are you going to enter into the trade and place the order? Next, of course, the strike price. What price do you want to buy in on from the stock? So, the name of the stock, you got the ticker, the time you got that, and hey, I'm going to buy this at $10. I'm going to buy this $11. You have to determine what the strike price is. Of course, after that, you need to determine and know the number of shares you want to buy. The price times the shares tells you the dollar amount you're going to spend. So your trade amount, of course, is something you're going to want to write down as well. I mentioned previously the importance of a stop loss. So again, when you're setting a stop loss, that's going to protect you on the downside. So you definitely want to set that and put that into your spreadsheet up front so you know when to get out of the trade. You also want to set your sell price for profit because again, you got into the trade to make money. So write your targets down so you know. And of course, after the trade's been executed, after you've either sold for profit or unfortunately, sometimes it'll happen. The trade hits your stop loss and you get kicked out and you don't win the trade, you're going to have a result. So you want to know and you want to keep track of your results. Rule number seven. Ooh-wee. Rule number seven could easily have been rule number one. Guys, Practice before you play. Paper trade before risking real money. There are numerous online tutorials out there, virtual trading assistants out there, virtual trading accounts that you can utilize in order to practice. Before you put your real money at risk, you want to come up with a strategy. Make sure that what you learn about reading stock charts is actually helpful in helping you execute winning trades before you actually put your real money at risk. I listed a few platforms here. Interactive Brokers is really one that a lot of people online like. Webull has one that I've heard people say good things about as well. There are many others, guys, but make sure you practice before you put your real money at risk. I always tell people to do at least 20 trades first. Uh, I go as far as saying go 2 weeks, do a trade a day, a couple trades a day, 5 days a week during the trading market hours for about a month to get comfortable before you actually dump your real money in. There you have it, guys. Those are Mr. Darson's 7 rules for trading stocks. If you implement these rules, these strategies, they will help you make good decisions, make money, and not lose too much on the downside. Happy trading, everyone.